right, so the qualified business income deduction is a new deduction that was created in 2018 with the TCJA, and it's just a magic deduction. It's just a freebie. You calculate a number and you get to subtract it from your income. And so we're going to take a look at how we do that because there are some confusing limitations that come along with that. But let's look at how we do those. Okay, the qualified business income deduction, QBI or QBID, it's great. It's a free deduction. You don't need to spend anything and you're going to get to deduct something for it. Generally, the net income from a partnership, S Corp, sole proprietor is considered qualified business income. So, I mean, this covers the whole gamut. Most people, you know, small businesses, I should say, are sole proprietors. And so they qualify for this magic deduction. And then the other two most popular ones we see that are small businesses are partnerships and S Corps. So, I mean, this runs the gamut on who gets to deduct this thing. So basically, this would be easy if they would have left it here. 20% of your qualified business income equals your deduction. So if you make a profit of $100,000 times 20% is $20,000. So you would get a deduction of $20,000. And now instead of having $100,000 you're going to pay tax on, you're only going to pay tax on $80,000. I mean, it's that simple. But they did some adjustments to it that we're going to talk about here in a minute. You subtract the deduction after you calculate your AGI. So this is what we call a below the line deduction. And let's look at some of the limitations. The first one is a 20% taxable income limit. Your QBI deduction cannot exceed 20% of your taxable income, not including interest and dividends. So they didn't want you to be able to exclude all of your income with this limits, with this deduction. So they put a cap on it of 20% of your taxable income. So if your overall taxable income is $80,000, you're only going to be able to have a maximum deduction of $16,000 for it. So let's see here. We got there. Bob runs a fish washing service that has a QBI of $100,000. He also earns $20,000 of dividends. So his tentative deduction is going to be $20,000. $100,000 of his qualified business income times 20%. So his QBID would be $20,000. However, the taxable income limit would be as follows. We have the $100,000 of income minus his standard deduction. He's a single, of course, this is 2018 numbers, equals $88,000. Now we would have to find out our limit, the 20% of taxable income limit. So we're looking at that here, and it's $17,600. Now remember, we're not considering interest and dividends here, so his overall taxable income is going to be about $120,000, but we're not considering dividends, so we're just looking at his business income and any other income he might have had. And so we come up with a limit of $17,600. Therefore, his deduction would be limited to $17,600. This one's pretty straightforward, makes common sense, and so that's the first limit we have to look at. What if Bob would have had $30,000 of itemized deductions? Well, now his limit's going to be even lower because he would have had $100,000 minus his itemized deductions equals $70,000 times 20%. And so now he's only going to get a QBID of $14,000. So here again, this is where we can start playing around, trying to figure out which way might be better for us. If we have a whole lot of itemized deductions and a whole lot of QBI, maybe we want to go with the standard deduction. And that's just one of the scenarios you run when you're trying to identify which way would be better for you and your client. Now we have the wage and qualified business property limitation. And this only applies if your taxable income is above these thresholds right here. And these are the 2018 numbers, so it's probably a little higher for 2019 and 2020. If your taxable income is below these thresholds, you can ignore this whole section right here. But let's assume that we're above these thresholds. And you can look for married filing jointly. This is a pretty decent threshold right here. You know, I think you're up into like 5% of people are married filing jointly are making this kind of money. So this limitation is not going to affect many people. So your limitation is the greater of 50% of the W-2 wages of the business or 25% of the wages plus 2.5% of the unadjusted basis of the qualified business property. And I know that was a mouthful. And that's where we got to start. Look, what they're saying here is the unadjusted basis of your business property. So quite often we'll look at a depreciation schedule and come up with whatever 2.5% of that is, and take that plus 25% of the wages. So the W-2 wages of the business is pretty self-explanatory. 50% of your W-2 wages, which includes your deferred wages. So you might have somebody who earned $100,000 but kicked in $10,000 to a 401k. So their taxable wages are only 90%, which if we took that, we'd only get $45,000. But we get to include deferred wages. So now we're looking at it as full $100,000. So we would get $50,000. So that's the first limit, 50% of the W-2 wages, pretty easy. But the 2.5% of unadjusted basis of qualified business property. So tangible property, not land. So tangible, anything you can touch, the building, the equipment, etc. You must have it at the end of the year. You must have been using it in the business during the year. And the depreciable period could not have ended before the end of the year. And the depreciable period is the later of 10 years of the last day of the last year of regular depreciation. I know, it's a mess. We don't get into this very often. Again, it doesn't affect very many people. And then we look at the 50% of the wages, which wages is quite frequently one of the largest items for most people. And so it's a little easier to calculate that. But if you had the property in your possession at the end of the year, you used it during the year, and the depreciable period did not end before the end of the year, then we're going to take 2.5% of it. So let's look at some examples of that confusion. W-2, Joan had a business and claiming wages of $80,000 as business deduction. Well, there you go. We got pretty simple. The first limitation, 50% of wages, $40,000. But now we're going to start looking at that other one where it's 25% of wages plus 2.5% of her property. So her qualified business property, remember the longer of 10 years or the depreciation period. So Joan has the following property. And remember, you use the unadjusted basis. So she has all this property that we're looking at, and its total is $290,000. Her QBP for 2018 would equal $210,000. The limitation would be 2.5% of that number, or $5,250, which you would then add to the wages, the 25%. And so her limitation would be $25,250. But we get to take the larger of the two numbers, $40,000 or $25,250. So if Joan's taxable income is above that threshold, she would have a QBI of $40,000. If her qualified business income without the limit, she would have had a QBI deduction of $50,000. And so that's where if she wouldn't have been above that threshold, she would have had a much greater deduction. So there's another one, the wage limit. This threshold is not an absolute limit. This is a phase-in. So the threshold of $315,000, the phase-in is from $100,000 for married filing jointly and $50,000 for single. You calculate your QBID with and without the limitation, then calculate your phase-out percentage, apply the percentage, subtract that from your QBID. And again, this is another thing where it just sounds so complex, but it's not too bad. So let's look at some people. They had $330,000, $300,000 is QBI, and business has wages of $80,000 and property of $600,000. First, calculate the QBID without the limit. Well, 20% of their qualified business income, $60,000. That's easy enough. Next, calculate it with the limit. Well, we have to look at which one of the two greater, the 50% of the wages or 25% and 2.5% of the property will give us $35,000. So we're going to use this $40,000. And now we're going to find our excess. So $60,000 is the amount without the limit. $40,000 is the amount with the limit. So we have a $20,000 excess, and we're going to find our phase-out ratio. $330,000 of taxable income minus our phase-out limit equals $15,000. So we're going to divide that by the phase out range. Remember, the phase out is 100,000 for married filing jointly. And so we're at 15% of that. And so we apply the phase out ratio to the excess. $20,000 excess times the phase out range is $3,000. Subtract the phase out from the QBID with the limits, and you come up with your QBID. Again, this sounds super complex. We don't really deal with this part very often because, again, the limit is pretty high up there, so we don't have a whole lot of worry about it. But if you do have this, we're going to have to worry about it a little bit, and this is how you do it. There's some great details in the books, and we're going to go over a lot of examples of it in class at our lectures, so don't get too freaked out if you don't understand this. The main takeaway I want you to have on this, the main takeaway I want you to have with QBID is that it's generally 20% of your qualified business income. That is the easiest thing to remember. Once you get that number down, the rest is pretty easy, because remember, that threshold is pretty far up there, and only about 5% of the people who file are going to hit that. So 95% of y'all will never have to worry about that 25% plus 2.5%, or whichever is greater. You won't have to worry about that. So the main thing I want you to remember, probably the one you'll have to work out on a test, is QBI times 20% equals QBID. So just remember that. Don't freak out about all that 50%, 25%, 2.5%, phase-in limitation, all that stuff. Won't going to test you on it. You'll probably never experience it in real life. And if you do, you're probably working for a CPA, and you can go ask the guy down the hall how you do it. Just kidding. You'll know how to do it. There's another limitation that only applies to certain people here. And again, if you exceed these thresholds, then you may not even be eligible for the QBID if your business is being an employee, which sounds kind of weird, but a lot of people have that. Or if you're a specified service trade or business, SST. And this one is what gets a few people here. So again, you've got to exceed this threshold, which, remember, for married filing jointly, this is only going to be about 5% of the people. So 95% of the people can ignore what we're talking about here. But if you're in an SST, which involves any of the services in the fields of health, law, accounting, actuarial science, et cetera, brokerage service, financial services, then you're not even going to be eligible for the QBID if you exceed this threshold. You're subject to the same phase-out limitations. So here's the summary that I've came up with here. First thing to do is to determine if your taxable income is above the thresholds. If it's not, then you're going to use the following of these two, the lower of these two items, 20% of your QBI or 20% of taxable income. And that's what happens for 95% of the people. We're going to use one of these numbers right here. That's pretty straightforward and simple. If you go over your threshold, then we have some problems here. Now your deduction is limited to the greater of W-2 wages, or 25% of wages plus 2.5% of QBP, your property. And this should be 50%. If your taxable income is over these limits, this is where your thresholds max out. Remember, your phase-out limit range is $100,000. So these numbers are $100,000 greater than these numbers here, $50,000 if you're single. Then your QBID is 0. So if your taxable income is $500,000, you don't have to do any math because you're phased out. It's only when you fall in between these limitations that you got to start doing a little bit of math to figure out whether or not you're phased out or not. So, I mean, that's it. In summary, I didn't make this up. They really complicated it this time. Self-employed people love this, because, there's not a lot of my clients are in that 5% making more than $315,000. And so they're getting 20% off of their income just for having a business. So it's a good thing. It's just complicated. My computer does most of the work, so it's not that hard. But just if you can remember the things on that summary screen, then you'll be all right. And ignore that because we don't have a test on Monday. That's it for Chapter 4. Coming up in Chapter 5, we're going to start talking about a few other things that can help save you taxes, like your HSAs.